All right, welcome back. So now deal with me, right? We're going to go slow, but the yields on these super long Japanese government bonds, well, they soared to all-time highs. The yields went high, right? This was on Tuesday, which is today, on weak investor demand as political calls for big fiscal spending flare up ahead of an upper house election slated for July. At present, the Bank of Japan is planning to reduce Japanese government bond buying after spring of 2026. Now, this plan is currently unchanged for the time being. Now, you'll recall when central banks buy bonds, bond prices go up, right? And that means yields come down. Central banks do this often to artificially keep rates low, right, to stimulate their economies. The Fed does it too. They buy bonds, they shoot the bond prices higher, which means yields go lower. And to put some numbers on it, the 20-year JGB, that yield rose as much as 15 basis points to 2.55%, which is the highest since October of 2000. After the Ministry of Finance announced the auction results early afternoon in Tokyo. That means they were selling bonds. They didn't get any takers. Bond prices went lower. The yields went higher. That's what just happened as they were trying to sell bonds to get money in to run their government. A lot of central banks do that, right? So I got somebody who's an expert to talk about this. Now, I used to spend a lot of time in Tokyo, but nowhere near as much as our next guest. Mr. Keith Fitz-Gerald has spent half his adult life. He's got a home in Kyoto. He knows all about what I'm talking about, and we thought we'd bring it to you because it's an interesting story, and it might have a big effect on the U.S. So please welcome to the show, Mr. Keith Fitz-Gerald. Now, Keith, bonds are sometimes a little bit of a nebulous subject for folks, and I've tried to really explain it to them in the basic terms is when we want to raise money, we sell bonds. We take that money, and then over a 10-year period or however long the bond is, we pay it back. But when we're selling a lot of bonds into the market, sometimes bond vigilantes or bond buyers don't want to pay a high price for it, so they put their hands down, and that drives the price of the bond down. The lower the price of the bond, the higher the yield that the borrower has to pay on the bond. It's pretty much that simple, correct?
It is. And one of the questions, of course, that many people here in the U.S. are saying, well, that's thousands of miles away. Why does that impact me? And the answer is deceptively simple. The global bond market is 5 to 7 times the aggregate size of many of the U.S. stock markets.
Yes.
So the cost of money impacts how stocks actually move. So the fact that the Japanese government bond has just gone bananas is a very telling canary in the coal mine for U.S. investors.
So, for instance, in 2021, 2022, the Fed was trying to keep our U.S. economy going after COVID, and they were artificially keeping interest rates low by buying a ton of U.S. bonds. They bought bond prices and kept them high to the point where the U.S. real estate market had been up 23% 2 years in a row, and they were still buying bonds to keep interest rates low. That's where all your friends were able to refi at 2.75% before everything rebounded up to, say, 7%. So that's a good example of a government artificially keeping rates low by buying bond prices higher. So we have the opposite situation in Tokyo where they're selling bonds to raise money for the government, and nobody wanted to buy them, and that shot yields higher, right?
Well, it does. And the irony here, right, is this isn't because Japan, which has got its own set of problems, suddenly decided we're going to wake up and pitch a fit. This is because the Moody's rating forced a global repricing of risk. U.S. Treasuries are the benchmark in risk-free assets, and a lot of the Japanese bond market is as a function or proxy for U.S. bonds. So when all of this got repriced here, all of that had to get repriced there. So the question is really what's next on 2 levels.
Right.
What's Japan's government going to do about it? Because Japan's got one of the oldest populations in the world, got one of the weakest economies. They've offshored everything over the years, and they have no foreign labor policy to speak of other than temporary workers. So how does that impact us? Well, what's going to happen to Toyota? What's going to happen to Honda? What's going to happen to Nissan? How is that going to impact the U.S. stock market, the companies that are building here, Nippon Steel, U.S. Steel's deal? I mean, there's a lot of blowback here potentially.
And so what do you think is going to happen? I mean, how will that affect the U.S. market?
Well, I think a lot of that's going to depend on what the Japanese upper house, the one body of their government, decides to do about continued fiscal spending in 2026. Now, closer in, I think more immediately what we've got to see is the next 48, 72 hours, how U.S. traders are going to view this. And we don't know how European traders think because those markets haven't opened yet.
Right, and so it made some headlines, and I agree with you because the price of money is being repriced all over the world because we did have a little bit of a movement with Moody's yesterday. And then there's things that we talk about a lot, but a lot of people don't understand. But when interest rates get involved and people want to borrow money in one country to buy stocks in another country, that's called the carry trade. I'm sure, obviously, you're very aware of that. So where do we stand with those types of things in this environment?
Well, that's an interesting question. I think, you have an example of that in play. Everybody talks about Warren Buffett buying Japanese trading companies, Sogo Shosha. But what they don't realize is he's probably using some version of the carry trade to do that. So it's not because he loves Japanese Sogo Shosha. It's because he probably figured out some currency moves that are beneficial to Berkshire. Now, closer to home, U.S. investors, this is a great opportunity to think about low beta, high dividend stock plays. Companies that are going to give you security if there's a hiccup in the next 6-12 weeks as a result of what's happening in Japan now.
And you stole a little bit of my thunder, but you're exactly right, because my wife had a house in Portage, Indiana, which is right around the corner from Gary, Indiana, where U.S. Steel is located. And it's a massive, massive factory right on the southern tip of Lake Michigan. And obviously, they're in play with Nippon Steel, trying to buy them. The Biden administration was against it. I believe the Trump administration is against it, too. But just recently, I think Nippon Steel sweetened the deal. Or can you enlighten me on that one?
Sure, they threw a couple $1 billion into the pot and said, hey, we're going to build more, we're going to help modernize, we're going to do all these great things to try to sweeten the pot and get the deal. But, that's classic Japanese as well. I think they got in over their skis on something they didn't fully appreciate. The political backlash probably caught them by surprise. Now the markets have moved under their feet and they're trying to figure out what to do about it. So logically, they're going to try to sweeten the deal and bring it home. I'm not sure that's going to work. I think the better play is to bet on U.S. Steel because it's U.S. Steel, not because Japanese steelmaker is suddenly interested.
But it's a great example about how these things are all interrelated, and you can't, you might think that it's got nothing to do with our stock market and our bonds, but it absolutely does, because ultimately, that bond market is a big global bond market, wouldn't you say?
Yes, and that's one of the things too. When you and I were first starting our careers, back when dinosaurs roamed the earth, global trade was what it was, right? But now it's a science and an art that probably should get talked about a lot more than it is. What people don't realize is that the book passes every day from U.S. to the Asia markets, back to Europe and back around.
Yes.
Then you get the Middle East, you get other parts of Asia involved in it as well. But it all folds together because the liquidity in the innovation is what drives things. It's not necessarily the technicals or even purely the fundamental stories that it used to be. You got to have this constant awareness of which way the wind's blowing, because if you can figure that out, you can go sailing.
You couldn't be more true, and a lot of folks don't get it. But when I had 16 years in London, 4 of which I ran a Japanese bank, and you're right. When we were there early in the morning, we were handling the Japanese flow. Then it would come to Europe, and that was our time zone, so we stayed there. And then before we went home at night, at 6:30 at night, we had the U.S. flows, and then we serviced the U.S. customers. So one 12-hour day, we got to service the Far East, Europe, and then the U.S., and that's how the world goes around. That's exactly what we're talking about here. So interesting stuff. We'll see what happens with Nippon Steel and U.S. Steel, because that's another whole story in itself. But I appreciate you coming on and just kind of walking us through this, because it does have some global implications. I really appreciate it. Thank you very much, Keith. Keith Fitz-Gerald coming to us from